So we'll move on to the next one, which is another liability, provisions and contingent liabilities. You can see that everything we've been doing, it's almost difficult to separate audit from financial reporting. And you know why? Because what you are auditing is financial statement. So financial statement is financial reporting. So how can you audit what you don't understand? And if you remember when we started earlier, I said I encourage you to have done FR before you do AA, or worst case scenario, you do both of them together. So you're learning FR, you're learning AA. So you can understand standards as you are also learning how to audit, because your audit is checking whether things have been done in line with the requirement of the standards. But not to say if you don't do it like that, you will not pass. You will pass, but you just need to do more work. So you need to learn the standard as you're learning the audit. Yeah. So take, for instance, look at this, provisions and contingent liabilities. We can't talk about this audit without understanding what IS-37 requirement is all about, because that is the standard that stipulates how provisions of contingent liability should be recognized. And based on the way they should be recognized, auditors now needs to check whether the clients have done what they ought to do. So which is where I always start from. What is provision? Yeah. Provision, you always know, it's a liability of uncertain amount or time. So let me say it's a liability of uncertain. You have uncertainty in amount, which means you are not sure how much. And likewise, you are not sure when you will have to pay it. So there is a doubt. You're just not sure, time and amount. And that is why the standard believes that usually there will always be three possible outcomes. There are always going to be three possible outcomes. Is either you have to recognize a provision, or you have to just disclose without recognizing, or you even might have to just ignore. But what determines when all of this will happen? That is what you need to understand from the IS-37 perspective. And that is how you're also going to be tested. Because when they give you scenario, and you will see, like I said, in questions, when we start into the questions now, they will give you a scenario that you have to check from that scenario. Should you be recognizing a provision? Should you be disclosing only without recognizing, or should you even ignore? Those are the things you need to be able to answer. Yeah. When do you recognize? The standard stipulates three criteria that must be met before you can recognize a provision. If not two out of three, the three of them must be met, all of them. First of all, there has to be an obligation, present obligation, yeah, as a result of past event. Likewise, for you to wash your hands of this obligation, for you to say this obligation is no more your problem, that you have settled this obligation, then that means there will be an outflow of economic benefit. When I say economic benefit, I mean assets. It doesn't have to be certain, but because if it's certain, then you won't say there's a certainty. Remember, we don't have certainty, but this time, this outflow, we can conclude that it is probable. Because we cannot say it is certain. If it is certain, we are not going to be calling it provision. We're going to be calling it liability straight away. But we are calling it provision because of uncertainty, right? But do we still need to bring it into our books? Yes, if it is probable, which means it is very likely. The third condition is that Yeah, we can have an obligation. We know it is probable, but what if we don't know how to estimate the amount? There's nothing we can do about it. So, which means before we can recognize, we must be able to make a reliable estimate. And I think this is also useful for you if you're writing FR, right? So, reliable estimate, extremely important. So, these three criteria must be met. When all of them are met, then we must recognize the provision in the book. So clients must recognize provision in the book. So if there is probably an issue with the client and his customers, maybe the customer has bought a product from the client and the product is not working very well, then if the customer decides to take the client to the court, should your client make provision, then you'll be checking, is there an obligation? Yeah, there's an obligation because we sold to these customers and we collected his money. So we have an obligation to deliver good service, good product to this client. Yes, there's an obligation as a result of past event. The past event was the sale that we made to him. Okay. Any possibility of outflow of economic benefit? Well, it depends on the court. So this guy cannot decide. Usually, courts will decide whether this is going to happen most times. Sometimes it might be easy to tell if we know that, yeah, we really messed up. Then we know this does not even have to go to the court. We can settle out of court and make that estimate. Then we can do an estimate which will be based on what the customer is asking for or the whoever has sued us is asking for, right? Or maybe sometimes we have to go to the lawyer to even get a reliable estimate. So we might need to speak to an expert on this one, right? But sometimes these three conditions are not always met. But it doesn't mean that we should ignore when they are not met. So instead of this being probable, it can be any other thing. So this is met, this is met. We said if outflow is probable, you make a provision, which means you recognize. So we said probable, you recognize a provision. But sometimes it is not probable, but instead we will say it is just possible. If it is just possible, we don't need to recognize provision. All we need to do is to just disclose. And this is what you call your contingent liability. You just disclose it, you don't post it in the statement of financial position. But sometimes it might not just be any of these two, and it's remote, which means it is very unlikely. Here is 50-50. Here is more than 50, but here is far less. So it's remote. In this case, we ignore. So, which means we do nothing. We don't disclose, we don't recognize. But ladies and gentlemen, all of these three, you as an auditor, you cannot tell which is the right situation. You will always have to get an expert opinion. And that is why in your procedure, when you are auditing contingent liability provisions and all, you will always have to refer to an expert. And in this case, your expert will be a lawyer because you cannot tell. Okay? Very important. So, which means if you want to think of a structure on how to come up with procedures, you'll be asking yourself, the first thing you need to be doing is, does the situation exist? So you'll be asking yourself to come up with procedure. You need to validate the situation. Is it true that there is a case? Is it true that we sold something to someone that is defective? Is it true that somebody gets injured while sitting on our chair that we produce? Yeah, you need to be able to validate. So your procedure, first of all, wants to validate the situation, yeah, which you can do, right? And how do you validate the situation? Yeah, you can speak correspondences with the affected person. Yeah, you can check correspondence with the affected person. You can even check board minutes because they will discuss it. That will tell you that the situation actually, yeah, truly happened. Yeah. Also, you can check if they made payment after year end. That means they've settled something. Yeah, all of that will confirm the situation truly exists. Yeah, so if you confirm situation exists, what about the amounts? Is it accurate? Yeah, you cannot do the estimate yourself. Likewise, you can check the post-year payment to see whether the amount they provided for before year end is reasonable. You can get a lawyer's confirmation on this one and speak to lawyer. Get a lawyer confirmation letter. Yeah. If it's something you can recalculate, you can as well recalculate. Maybe if it's say redundancy provision, yeah, you can recalculate that because they would have agreed with the staff how that redundancy will be paid. You can as well recalculate the amount. Okay. Then whether it's probable, possible, remote, lawyer straight away. And that is the approach you will always use. And we'll solve questions. Let's wrap it up with share capital. That's pretty easy. Hardly tested, but you can be lucky. Share capital and dividends. Let me quickly touch on share capital. Yeah. Share capital, you all know, is about the shareholders. It's about the number of shares they have bought multiplied by the nominal price of one share. So this is usually your share capital. Right. So for you to be able to audit all of this, you need to know how to audit this. How do you know the number of shares they have issued? And likewise, the nominal price, and also how many people, because how many shareholders. So all of this, you need all this information for you, because these are the things that will make up your share capital, the share capital figure that you're looking at. So when you picture it like this, then you know that you need to find a procedure to address this. You need to find a procedure to address this. You need to find a procedure to address this. Yeah. And for you to know what the nominal price of their share is, it's going to be in the incorporation document. So you need to obtain incorporation. Yeah. Document. Might be certificate of registration, incorporation, and all of that. So, but you can just call it obtain the statutory incorporation document and agree the nominal price of share. So the amount stated on FS. Yeah. Likewise, there's always something we call shareholders register. Shareholders register is just like the same document you have for asset. It's the asset register. It lists out all the assets that you have. Likewise, every company has their shareholders register that lists out all their shareholders, the number of shares they are holding. So that will take care of this as well. So you need to obtain shareholders register to determine number of shareholders and number of shares held per shareholder. Yeah. And sometimes the question might give you a question whereby they have issued some shares during the year or something. In that case, you need to obtain board minutes because they must have approved that. So you need to obtain board minutes. It's what have been discussed there. Board minutes to validate approval for, it can be new shares, it can even be share split, yeah, for, let me call it share adjustment. Yeah, so if the question is about addition, then it will be share addition. If it's about split, which means they are sharing, dividing one share into two, that must also be discussed. If it's consolidation of shares as well, which means they are merging three shares into one, 2 to 1, all those kind of things, yeah, that must have been approved by that board meeting. Yeah, so that will address the share capital. Then if you're looking at dividend must always be declared, yeah, and that must be approved by the board. So board minutes will help you for that. You need to check board minutes to take care of that. Likewise, the payment of that dividend, you trace that to the bank statement. Yeah. I hope you know why I'm not writing it in full, so I can cover more things for you, because by now some of these procedures I've written them before, so I don't have to rewrite them. You can write them all by yourself, I believe. Right? I hope that is cool.